Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Monday morning. Hope we did something kind of fun over the weekend, or at least got away from the charts for a little while, because they are going to be increasingly difficult to get away from. A lot of you might have seen the news where the 22-hour trading day NYSE has been approved. It's on. Doesn't mean, by the way. So let's tackle one of the first big news items of the week, not economic data, but just the reality of modern day trading. Whenever we have a market that extends past the regular hours, and I've been trading Forex for decades now, so I can tell you, even though that's the largest market in the world, it's nothing bigger than Forex, not even close. And even though, yes, it trades 24 hours a day from Sunday evening to Friday evening, it doesn't even close. It doesn't mean that every hour has the same liquidity, participation, follow through. And what I usually tell traders is, if you were to look at 8 a.m. to noon Eastern versus 8 p.m. to midnight Eastern, those 4 hours, 12 hours apart, the turnover or the liquidity in the language of our stock market, the open interest, the shares traded, the volume, it's not going to be the same. Just because something's open doesn't mean there's participation. So even though this is a cool thing from a risk management perspective, because what's neat is if something happens overnight, there's an argument we could participate. But remember, the futures markets are open: S&P, NASDAQ, Russell, Dow, gold, crude, bonds, and those are probably going to continue to be far more liquid. But it is pretty cool that the equity markets are starting to do that. I don't think it's bad. I don't think it's good. It just is. And that means that we have to follow that volume, follow that participation. And it would be pretty interesting to see how that's going to play out. All right. So next up, let's go ahead and take a look at what's going on in the ES and the NQ. We had a mean reversion on Friday. And it does seem that there's a little bit of a settling down in that sell-off. A lot of that weakness, we talked some about it on Thursday and Friday, because Jerome Powell has put a huge question mark over the expectations of the rate cut. And, it's going to put the inflation conversation back into focus. It's going to put a lot of the uncertainty around what that accommodative monetary policy has meant to anticipate it. And then now what it means if we can't anticipate it as greatly. So right now, it's not a coin flip by any stretch. It's not a 50-50 hike or hold. But what it is whether or not we're going to see that quarter point cut roughly a month from now. It's an entire month from now. There's a lot of data between now and then. There are some simple things that would get this right back up to 80%. If non-farm payroll is a miss in that December number, we're going to get that the first week of December, that Friday. If that's a miss, this goes right up again. If other inflation type metrics are a little flat to cool, this will go up again. So don't worry about what's real. I think this conversation constantly where traders want to confuse themselves with being economists. I see it in the comments, and it's rather hilarious where these conversations come up, but no one talks about positions, right? We're traders. No one pays us to talk about the market. They pay us, meaning if we're traders and we're engaging with the exchange, we need to put a trade on. So it's amazing when people do want to talk about this. And the next time someone does say, hey, ultimately what we have is oh, yes, gang, I got the date wrong. Yeah, okay. Can we move on from that? Yeah, we got the date wrong. I've only done about 400 of these shows. Every now and then I'm going to get a date wrong. Okay. So if we think about where we are in terms of that discussion about whether they cut or not, so then what's the position, right? That has to be the conversation. So if you start hearing people discuss, hey, recession could be here, stagflation could be here, whatever, the only answer to that question is, okay, and this is the position that I'm going to put on. And that's always lacking, right? That's always going to be lacking because that's not ever going to be an answer that they have. So we don't want to engage in that discussion, right? We don't want to engage in that discussion. Ultimately, what we do know is that if we have expectations of a Federal Reserve not willing to cut in December, the upside will be a little tougher to come by, right? The upside follow through, the consistency with the higher highs may not be there. Could we chop in that bullish area? Yes, we could chop in that bullish area, right? But that's about it. That's about it. And you'll see that bullish area has been defined. Take a peek here. Sorry about the background noise. I don't know if you can hear that or not. You can see the chop that's been defined here by the, see that right there? This the Darvis 2.0 resistance, the Darvis 2.0 support. I'm going to cut that range in half so I know sort of where we are at the lower end of the range. And then what I like to do is cut that range in half again. You know, one of the things that a lot of traders will do is they'll start to presume that any chop is a compression, and that could not be further from the truth. Because what happens when traders presume it is a compressed market, they'll wait for a breakout or breakdown. You know, case in point, things like Meta. This is not a compressed market where you're looking for a breakout, breakdown. This is a choppy market that's going to go seek out overbought resistance and oversold support because it's in a wider range. So some of these stocks are very much just in chop. The S&P and the NASDAQ, we can argue, are now in chop. So it's not as if we're waiting for some sort of momentum breakout. And you know, be aware that the weekly time frame, if you've got a longer view of this, and I think probably the best thing, you know, personally that I've had in my trading career is not go focus only on long term or go focus only on short term, but know which one I'm doing, right? So in other words, if I'm looking at a weekly time frame, and one of the things we do in the Sector Secrets Mastery is the first Tuesday of every month, we step back and say, hey, let's look at our shares. Let's look at our buy and hold. Let's look at our portfolio positions and what are the trends on the weekly time frame. And I build a lot of positions on that. The weekly time frame in the NASDAQ is up. So if I'm going to be bullish, say based on weekly price action, where there's one candle per week, I'm going to be bullish on the NASDAQ. There's no reason for me not to be. If I take a look at the S&P, and again, I'm not thinking day trading. I'm not looking at the end of day for swing. I'm looking at the weekly chart for the S&P. It's up. So my longer term setups, my longer term weekly time frame mean reversion, and the trend is up. That has nothing to do with what I would do on a 1 hour chart. It has nothing to do with what I would do in a daily time frame. So probably one of the best things I've done. And I still see ludicrous things like, hey, you know, the monthly chart, like, are you kidding me? A monthly chart? How do you manage risk on a daily time frame if the setup is on a monthly time frame where each month is one candle? These are the ridiculous things that multiple time frame confirmation start making sound very logical. Good luck managing risk, right? So if you're looking at time frames and you're struggling with, yeah, Rog, I don't get why someone's talking about weekly and monthlies if they're trying to swing trade over the course of the next 2 to 10 days, because they frankly don't know what they're doing, right? It sounds good. It sounds like it should be important, but it's really not. So use each time frame as a standalone. It's a little unusual. It's not what most traders do, because they're just kind of force fed the whole multiple time frame confirmation. But say, you know what, if I'm going to day trade, I'm just going to look at that one time frame, 2 minute, 3 minute, 5 minute, whatever you like, but pick one time frame for the job. If you're going to swing trade with the overnight exposure of maybe days to weeks, do it on the daily time frame or whatever you like, right? Use that one time frame for the job, and don't worry about what a time frame below it or above it is doing, because the structure and the psychology of each time frame can be very different. We see this, by the way, if there's an intraday pullback on, say, a 5 minute. We could have an intraday downtrend on the S&P while there's still an overall uptrend on the daily. Do the two of them have to agree? Not at all. Not at all. In fact, they're not even measuring the same psychology. Yes, they're measuring the S&P, but in a very different way. And this is what multiple time frame analysis is not going to, in fact, it's going to confuse that whole thing. And then all of a sudden you're putting on a daily time frame because something looks interesting on a monthly, forgetting that that monthly is one candle per month, right? Okay. And then here's a real downside to this. And I've been there. I'm telling you from firsthand experience. The other worst thing about it is when one time frame doesn't agree with the trade that we have on, what do? We just go look for another time frame that agrees with us. And that's another slippery slope to multiple time frames. So this is where we are. It's generally a bullish environment. We know there might be some chop ahead because we're not certain of the Federal Reserve's decision on December 18, unlike the November decision, unlike the September decision, where it was fully discounted of some lower rate as the result. But we don't have that right now for December. But probabilistically, the rate cut is still slightly more probable. It's just not fully discounted. And that's important. That's important macroeconomic information, again, what the Federal Reserve is going to do. All right. So question here, crude oil versus natural gas. I'm going to leave crude alone right now. So undiscovered, if I'm bullish, I'm going to go with crude. If I'm bearish, I'm going to go if I'm bearish, I'm going to go with crude. So if I'm looking at more downside, but if I'm bullish, I'm going to go with natty. So it depends on what you want to do. Do you have a bearish take on energy or do you have a bullish take on energy? Whichever one that is, then that's going to direct you to one or the other. Now, if you want to be bullish in natty, I would also recommend taking a look at FCG and XOP. All right. Let's see what else we have here. Amazon, is it good to enter now? Okay, so let's talk about Amazon. Gang, I never think about holding for 1 month. I never think about how long I'm going to hold it like that. So I'm just going to skip on that part of the question because nobody knows. I don't know where that psychology has come from, where we have to be right, not only on price, but for how long that price will follow through. Again, I cannot emphasize that enough. Nobody knows. And not only does nobody know, it's basically not super useful because what if it goes longer for a month? What if it only goes 3 weeks? Do we not take profit because the time horizon was 1 month? So be careful with that time horizon element. Let's just follow the trend for as long as it will go. That said, I do like Amazon. It's one of the symbols that we've been looking at pretty consistently in the mastery. There's a few symbols that we've been looking at a lot throughout last week, I believe, Amazon and the other one was Alcoa that we were, and Amazon, Alcoa, Schwab, Cisco. These are some of the names. And yes, I do like Amazon. One of the things that we decided going into Friday was, even though there were a lot of really good pullbacks to zones that we like, they were pretty dramatic. And I thought if we're going to see a little bit more weakness into the open, it might be this first 30 to 60 minutes of today, of Monday. And yes, I do like Amazon. We'll see where the daily price movement range ends up being in terms of at the open. But I would like to be a buyer. I just don't know quite where yet. But clearly we have the directional bias. I would look at it in terms of Amazon, the expiration that I would buy. Right. So let's talk about, okay, what expiration would you buy? I would look at least at December 20. In fact, now that we're past the X, the next big expiration in terms of where the size is at, it's going to be the third Friday of December. If you want to take advantage of some of that window dressing, Santa rally that can happen, into Christmas time past the 20th, then in certain stocks, if there's liquidity and the affordability is there are some December 31 expirations, but they may not be all that liquid. And then, of course, I would push us out to January 17, which frankly is kind of spendy, but it's something you can look at. But for right now, the bulk of my overnight swings are going to be December 20. That's that window of follow through. It's where I bought it and where it's going to expire. All right. Next up is, do I use the pre-market data in my analysis? I use the pre-market to run many of my indicators. In this way, if I'm looking at the S&P, it's already got a running start. It's already opening. There's good size in it, at least since 7:30 Eastern. And 7:30, there starts to be good open interest or good volume, sorry. But it runs my indicator. So if my indicator are waiting for the bell, that means the first price action that's even digesting was right at the bell. And it's going to take a little bit of data to properly feed the indicator. So my indicators do. As far as pre-market analysis, I don't use it for stocks because what happens in stocks pre-market does not necessarily mean we're going to see that at 9:30 or even after. For the S&P, for the NASDAQ, for gold, for crude, I really wouldn't consider that pre-market, right? Pre-market has a connotation of the markets aren't really open, and they actually are. The futures markets are already open. And so for stocks, I'm not super attentive to that, but I am in that if we're close to a target, I want to be ready. For example, Schwab, we have a position in Schwab that's starting to move a little bit higher. Perhaps I might be ready, but no, I don't use it for stocks. And again, technically the S&P, the futures contracts are not in a pre-market. Those exchanges, Chicago Mercantile Exchange, the CBOT, the Chicago Board of Trade, they're already open. Their day starts long before the cash open. So, what we call pre-market is usually from the perspective of the cash market, Wall Street's bell. Yeah. As far as Square, if it pulls back, it's a trend, and I think is a valid entry. There's two ways you can look at it. A mean reversion, or I'll just pull a 50%. As we get down to 80 to 79.5, that may not be a bad idea. All right. Next up is Tesla. Let's see. In last Thursday's trip, and what are my Tesla targets? Oh, I don't have Tesla open, but if you're looking at targets, depends on where you got in from. If you're looking at the gold zone as a target from, let's say you bought, and it's probably easier to see on the 1 hour. All right. So for whatever reason, let's say somebody bought either on Thursday, which I would have liked Friday a little bit better, but if you bought lower, whatever that lower is, if you bought lower, and then you're looking at paying yourself when the thing goes higher, that would be basically here, right? And then wherever the daily price movement range is when the bell rings, which should be a little bit higher. So I would look at where the DPMR is after 9:30. All right. What else do we have here? Is that it on the questions? I think it is. All right, gang. So I'll just wrap it up there then. I'll be hopping into the Sector Secrets Mastery. We are going into window dressing season, which is to say we are going to start to see the names that have been strong, most especially in Q4, continue likely to strengthen. Does it mean the broader averages and everything are going to go up? No, it's on a rising tide. It's really a preferential tide that's going to continue to benefit in terms of flow into stocks that have already seen good strength, and they'll likely continue to be supported. That's going to be the window dressing component. A lot of what we're going to be dealing with over the course of the next 6 weeks, which is actually pretty great because we're already following trends, and we're going to presume those trends are going to remain intact, supported, and tended to. All right. So in the meantime, gang, have a terrific Monday. I'll see you tomorrow, same time, same station. And by the way, I'll do a makeup session for top tier. I decided to relax yesterday, so we'll do a makeup session for top tier at some point this week. All right. Be good to each other.